U.S.-China relations are top of mind heading into Trump 2.0, as the president-elect has proposed an additional 10% tariff on China, while also threatening levies as high as 60% on all Chinese goods. This all comes as China's economy continues to be under pressure, with an unexpected slowdown in retail sales, adding to the macro backdrop confusion. For more on how Trump policies could impact this relationship, we've got Shehzad Qazi, China Beige Book's International Managing Director. Shehzad, it's great to have you on here. So the Chinese economy is still clearly under pressure. It's clear that these tariffs are coming to some degree. How much power does Beijing have in tariff negotiations given the struggling macro backdrop in APAC?
Yeah, look, I mean, the Chinese economy is certainly weak, not catastrophically so, however, and that's a very important point. I think rather than just looking to negotiate, what Beijing is going to try to do is hit back and retaliate, I think, as hard as they feel that they need to, depending on what the tariffs look like. But I think even more importantly, what they're going to be focused on over 2025 is making sure that the tariffs are being met with as much monetary policy support and I think as much fiscal spending as is needed in order to counteract their impact. And I think a lot of that would really just come down to heavily supporting the industrial economy, the manufacturing economy in China.
Shehzad, what do you think, and we're showing pictures right now of President-elect Trump and Xi Jinping in the past, when you come to how this relationship is likely to play out over the next 4 years, when you talk about the likelihood of tariffs, maybe to the extent of the tariffs that could potentially be implemented, and then you also have President Trump extending the inauguration invite to Xi Jinping, which is pretty substantial in and of itself. What to you does that signal about their relationship between these two world leaders, and what investors should take away from that?
Well, so, they've done this before. We've already seen round one, and round one ended, of course, with a trade deal. And that's what markets are getting very excited about. They are very convinced that there is going to be another deal. But I would caution very, very heavily against that. I think this time around, the Trump team is coming in with a far more aggressive agenda. A lot of the press reporting between there being a lot of daylight between what the incoming Commerce Secretary would like to do versus what the traditional trade folks want to do, I think it's overplaying. There's a lot more similarity. There's a lot more convergence of opinion than anything else. And the Trump team is coming in understanding that the president wants to go hard, and that's what they're there for. They're there to implement policy. This is not like Trump 1, where you've got a bunch of staffers who are going to be fighting constantly trying to convince the president to go in different directions.
But in terms of the reaction function of Beijing, is there sort of a requirement now for Beijing to finally issue some stimulus to consumers given the pending threat of tariffs?
They're not going to, I think, go big on the consumer side at all. It's sort of almost antithetical to their ideological convictions, at least so far. Plus, I think what they want to do is make sure that they're supporting their companies. They want to make sure that they remain a very important dominant power as far as manufacturing is concerned. We hear about new productive forces all the time out of China now. They want to be a major player in high-tech manufacturing. And so the focus of their stimulus policies is going to predominantly be on the industrial side, I believe. And of course, the real takeaway there is, does that exacerbate the very trade problem that's inviting these tariffs to begin with?
Does it, do you think?
I think so. Absolutely. Look, Chinese overcapacity is here to stay. It's not going anywhere. And so if they keep doubling down on this as they have, it's only going to create more and more, I think, problems. And it's not just going to be an America-China story anymore. We've already seen emerging markets taking action. So Chinese overcapacity, I think, is here to stay. And more tariffs and more trade wars across different countries vis-a-vis China, I think that's the future we're looking at.
So then, can the Chinese market, given that, coupled with the fact that we are also seeing some of these econ data, Maddie referenced the retail sales number that was out this morning, obviously very weak and emphasizing some of the challenges facing the country right now. Can the market side of the story when it comes to China, can that still be okay, given all of these challenges?
I think the market might get some positive surprises. Look, if you look at the property market, it's clearly showing some signs of stabilizing at a low level. But those declines that we had gotten so used to, it seems like there's some breathing room finally in place there. These retail sales numbers are not altogether, by the way, that bad. We saw some retail weakness. We saw more services weakness in our November data, but that could turn around as more stimulus comes along the way. There could be incrementally, somewhat better numbers, even if they're not magically, better numbers. So I think the market may actually have some positive China stories to pull on next year. And of course, the other big one I should mention is, the improvement in corporate borrowing, which we saw after a very long time. So business confidence actually may not be as dour heading into the end of this year, beginning of next year, as currently the consensus has it.
All right, Shehzad Qazi, always great to get your insight. Thanks so much for taking the time.